Imagine this. You wake up one morning, you grab your phone like you do every single day, you open your portfolio app, and everything is red. Not just a little red. Not the kind of red where you shrug and make yourself a coffee. I mean blood red. Your stocks are down 15%, 20%, some of them even more. Your total portfolio is sitting thousands of dollars below where it was just 48 hours ago. And you're sitting there in your bed, heart racing, palms sweating, thinking, what do I do? Do I sell everything before it gets worse? Do I hold and hope? Do I actually buy more right now? You genuinely have no idea. And the worst part? The news is playing in the background, and all you can hear is one word repeated over and over: war. That's not a hypothetical scenario. That's the reality that millions of investors around the world are facing right now, today, as you watch this video. And if you're here, you're probably feeling some version of that exact panic. Maybe you've already made some moves you regret. Maybe you sold something at the worst possible time. Maybe you're frozen, completely paralyzed, not sure whether to act immediately or just wait and see what happens. Maybe you're just desperate for someone to sit down with you, cut through all the noise, the fear, the contradictory headlines, and tell you clearly and honestly, here's what you need to do. That's exactly what this video is. My name is Max, and today I'm going to walk you through a complete, actionable framework for investing during wartime. What to buy, what to sell, what to avoid entirely, how to structure your portfolio, and most importantly, how to think about your money when the world feels like it's genuinely falling apart. Make sure you watch until the very end, because the last section is the one that most people skip over or ignore, and it might be the single most important thing you hear all year when it comes to building and protecting your wealth. Let's get into it. Why war changes everything for investors. Before we talk about specific moves, we need to understand why war affects financial markets so dramatically. Because if you don't understand the mechanism, you'll always be reacting instead of anticipating. And reacting is how you lose money. Financial markets, at their absolute core, run on one single thing above everything else: certainty. Or more precisely, the expectation of certainty. Investors, institutions, hedge funds, pension funds, sovereign wealth funds, all of them need to be able to model the future with some reasonable degree of confidence. They need to know what interest rates are going to look like 6 months from now, what supply chains are going to look like, what energy prices are going to do, what currency values are going to be, what trade routes are going to remain open. War destroys all of that certainty, not gradually, not slowly, in a matter of hours. When Russia invaded Ukraine in February 2022, the S&P 500 dropped sharply within days. Oil spiked over $100 a barrel almost overnight. Wheat futures exploded because Ukraine is one of the world's largest grain exporters. Gold jumped as investors rushed to safety. Defense stocks surged 20%, 30%, some even more in a matter of weeks. Semiconductor stocks dropped because supply chains through Eastern Europe were suddenly in question. None of this was random. None of this was panic without reason. That was the market doing exactly what markets are supposed to do, rapidly repricing every single asset class to reflect an entirely new geopolitical reality. Here's the insight that separates sophisticated investors from everyone else. The market doesn't react to what's currently happening. It reacts to what people expect to happen next. That distinction is everything. By the time the news confirms what's occurring, the market has often already moved significantly. The people who profit are the ones who understand the seconds and third-order consequences of geopolitical events before those consequences show up in the headlines. So, when you're investing during wartime, you are no longer simply analyzing companies and their earnings. You are analyzing geopolitics. You're analyzing energy supply chains. You're analyzing which nations are directly involved, which ones are adjacent and vulnerable, what natural resources are at stake, which trade routes are threatened, how long the conflict is likely to last, and how the major global powers are going to respond diplomatically, militarily, and economically. I know that sounds overwhelming, but the framework we're going to walk through today makes it manageable. And here's the brutal truth that almost nobody in mainstream financial media will say directly. War creates some of the most significant wealth transfer events in modern history. The investors who understand what's happening and position themselves correctly during these periods don't just survive. They build generational wealth. The investors who panic, sell everything at the bottom, move to cash, and wait for things to feel safe again. They miss the recovery entirely. They buy back and near the top and wonder why their returns are so disappointing. Which one are you going to be? That choice is being made right now, whether you realize it or not. The sectors that win during war. Let's get into the specifics, because the most important thing you need to understand is this. Not every sector suffers during wartime. In fact, several sectors perform extraordinarily well. And if you don't have exposure to them right now, you are missing one of the most powerful tailwinds available to investors in this environment. Defense and aerospace is the most obvious one, but the magnitude of the opportunity is something most people still underestimate. When a major conflict breaks out, every single government in the developed world starts looking at its military budget and asking the same question: are we actually prepared if this comes to us? The answer is almost always no. After decades of post-Cold War budget cutting, most Western nations let their defense capabilities atrophy. Now they're in emergency rebuilding mode. NATO countries have committed to spending 2% of GDP on defense, and several are now pushing toward 3% or even more. That's not billions of dollars. That's hundreds of billions of dollars flowing directly into the defense sector over the next decade. The companies building the jets, the missiles, the ships, the drones, the radar systems, the satellite communication networks, they are sitting on multi-year backlogs of contracts that provide extraordinary revenue visibility. This is not a short-term trade. This is a structural, multi-year, potentially multi-decade investment theme. If you have zero exposure to this sector today, fixing that should be your first priority. Energy is the second major winner, and it's deeply connected to why wars start in the first place. Conflicts, especially in resource-rich or strategically located regions, almost always involve energy. When fighting disrupts pipelines, threatens shipping lanes, or destabilizes major oil and gas producing regions, energy prices spike hard and fast. We saw this in 2022. But the more important point is this: the geopolitical lesson that every government in the world has now internalized is that energy dependence on adversarial nations is a strategic vulnerability that cannot be tolerated. The response to that lesson is a massive, sustained investment in domestic energy production. That means oil and gas producers in stable, friendly countries become dramatically more valuable. It means LNG export infrastructure becomes a national security priority. It means pipelines, refineries, and storage facilities are being built and expanded with government backing. If you want to align yourself with one of the most powerful policy and capital allocation tailwinds in the current environment, energy is where you need to be looking. Commodities broadly, gold, silver, copper, uranium, agricultural commodities, these become critical holdings during wartime. Gold in particular has been humanity's store of value during periods of uncertainty for literally thousands of years. It doesn't generate cash flow, it doesn't pay dividends. But when fiat currencies feel unstable, when inflation is running hot, when geopolitical risk is elevated, gold does exactly what it's always done. It holds value while everything else wobbles. Silver has both monetary and industrial applications. Copper is essential for electrification and defense manufacturing. And uranium, this is one of the most underappreciated wartime and post-wartime plays available. The global push toward energy independence is triggering a renaissance in nuclear energy that is accelerating faster than almost anyone predicted 2 years ago. Cybersecurity is the wartime sector that most retail investors completely miss, and it might be one of the best risk-adjusted opportunities available. Modern warfare is not fought exclusively on physical battlefields. It is fought simultaneously in cyberspace. State-sponsored cyber attacks on critical infrastructure, Power grids, water systems, financial networks, communication systems escalate dramatically during active conflicts. Every company, every government agency, every hospital, every utility knows this, and they are signing emergency contracts, accelerating upgrade cycles, and spending at unprecedented rates to harden their defenses. The cybersecurity companies that provide those solutions are seeing their sales pipelines explode. This is a theme with both immediate wartime demand and massive long-term secular growth, which makes it one of the most compelling places to have exposure right now. What to avoid? Right now, knowing what not to own is just as important as knowing what to buy. And this is honestly where most investors make their most costly mistakes, not by missing the winners, but by continuing to hold the losers. Consumer discretionary gets hit hard during wartime environments. When people are scared, genuinely scared about the world, about their jobs, about the economy, they stop spending on things they don't absolutely need. Luxury goods, travel, restaurants, entertainment, retail. These sectors face demand destruction that can be severe and prolonged. If you're significantly overweight in these areas, now is the time to reassess. Emerging markets with conflict exposure. This is critical and often overlooked. Many people hold broad emerging market ETFs without actually knowing what's inside them. If those funds have significant exposure to countries that are either directly involved in a conflict or are geographically and economically adjacent to one, you could be exposed to far more risk than you realize. You need to look under the hood of every fund you own and understand your actual geographic exposure. Long-duration bonds are a trap that too many investors fall into during uncertain times because bonds feel safe. But war drives inflation. Inflation is the enemy of fixed income assets. When inflation expectations rise, the real value of the fixed coupons those bonds pay collapses. Long-duration government bonds in particular can experience devastating losses in inflationary environments, as 2022 demonstrated in what was one of the worst bond market years in over a century. If you're holding a traditional 60-40 portfolio and thinking the bond allocation is protecting you, you need to reconsider that assumption urgently. The psychology of wartime investing. Here's where I want to spend some real time, because this is the part that determines everything. You can have the perfect portfolio strategy on paper, the right sectors, the right asset allocation, the right geographic diversification, and still completely blow up your financial future by letting your emotions override your logic during a crisis. Fear is the single most destructive force in retail investing. Not market crashes, not recessions, not even wars. Fear. Because fear doesn't just cause you to sell at the bottom. It causes you to stay on the sidelines long after the bottom has passed. It keeps you in cash while the recovery runs 30%, 40%, 50%. It makes you feel like you're being prudent, being careful, waiting for more information, when in reality, you've simply let panic override your ability to think rationally about long-term value. The reframe that changed everything for me is this simple. Market crises are sales events on quality assets. That's it. When a great business that was worth $100 per share last month is now trading at $65, not because the business got worse, but because the macro environment got scary. That is a discount. That is the market offering you something valuable at a reduced price. The question you have to ask yourself is not, is the world scary right now? The answer to that is obviously yes. The question is, will this business be worth more in 5 to 10 years than it is today? And for quality companies in strong secular growth sectors, the answer to that is almost always yes. The investors who built the most wealth in history, the ones we study, the ones whose books we read, they didn't build it by buying when things felt comfortable and safe. They built it by buying when others were running for the exits. That's not bravery for its own sake. That's understanding that price and value are two different things, and that fear temporarily disconnects them in ways that create extraordinary opportunities for those who can stay rational. How to structure your wartime portfolio. Let's get practical and tactical. If I were restructuring a portfolio today, specifically designed for the current geopolitical environment, here's exactly how I would think about it. First, I would ensure meaningful exposure to real assets, gold, commodities, energy. Not a speculative bet, a structural hedge. Somewhere between 10% and 20% of the portfolio in assets that hold real-world value when paper assets are volatile. Second, I would build defense and cybersecurity exposure. This is the core of a wartime positioned portfolio. Quality companies with government contract backlogs, strong balance sheets, and exposure to the rearmament and digital defense themes we talked about earlier. Third, I would focus on energy independence plays. Domestic producers, LNG infrastructure, nuclear energy. Companies that benefit directly from the policy tailwind of governments desperately trying to reduce their exposure to hostile energy suppliers. Fourth, I would maintain a cash reserve of 15 to 20%. Not because cash is a great investment. In inflationary environments, it's not. But because having dry powder when opportunities present themselves is an enormous strategic advantage. You cannot take advantage of a sale if you're already fully invested when the prices drop. Fifth, I would ruthlessly review my existing holdings for exposure to the sectors we identified as vulnerable. Consumer discretionary, long-duration bonds, emerging markets in conflict zones, and reduce or eliminate positions that don't make sense in this environment. What history tells us. The long game. Let me zoom out and give you the single most important piece of context for everything we've discussed today. Because I think in moments like this, when the news cycle is relentless and every headline feels catastrophic, it's easy to lose perspective entirely. Here is what history tells us, without a single exception in the modern era. Markets recover. They don't just recover. They go on to reach new all-time highs. After World War I, after World War II, after Korea, after Vietnam, after the Gulf War, after 9/11, after the 2008 financial crisis, after the COVID crash of 2020. Every single time, without exception, the market eventually found its footing, recovered, and surpassed previous highs. The investors who panicked during those periods, who sold at the bottom and waited on the sidelines, they locked in permanent losses and missed the recovery. The investors who held quality assets and continued to accumulate during those dark periods, they were rewarded spectacularly. This is not debatable. The data is overwhelming. And here's the other thing history tells us that almost nobody talks about in these conversations. The companies and sectors that emerge from wartime environments often go on to define the next economic era. Post-World War II. American manufacturing dominance shaped the global economy for 30 years. Defense technology from the Cold War gave us the internet, GPS, and much of the computing infrastructure that underlies modern life. The investments you make during chaotic, scary, uncertain periods aren't just about surviving the present. They're about positioning yourself for the extraordinary opportunities that exist on the other side of the storm. The mistake that will cost you everything I want to end with what I genuinely believe is the most important message in this entire video. The mistake that I see intelligent, well-intentioned investors make over and over again during periods of market stress. The biggest mistake you can make right now is not selling too early. It's not buying the wrong asset. It's not mistiming the market. The biggest mistake, the one that has the most devastating long-term financial consequences, is doing absolutely nothing. Complete paralysis, waiting until things calm down, waiting for more clarity, waiting until it feels safe enough to make a move. Because I promise you, it never feels safe. The bottom never announces itself. The all-clear signal never rings. By the time the situation feels calm enough and clear enough to act, the market has already priced in the recovery. The smart money has been deployed for months. You're buying back and near the top, thinking you were being cautious, when in reality you bought high, sold low, and called it prudence. The investors who build real, lasting wealth are the ones who have a clear framework, who understand the historical context, who identify quality opportunities at discounted prices, and who act even when it is deeply uncomfortable to do so, especially when it's uncomfortable. That's where the real edge lives, because most people cannot do it. Most people let their fear win, and that fear is exactly what creates the opportunity for the people who refuse to let it win. Right now, in this moment, you have a real and meaningful choice. You can close this video, feel vaguely informed, and go back to watching the news, feeling anxious and doing nothing. Or you can take everything we've covered today that makes the sectors to buy, the assets to avoid, the portfolio structure, the psychological framework, and apply it to your own situation. You can make decisions from a position of strategy and historical perspective instead of from a position of fear and paralysis. Every generation of investors has had to navigate their version of this. There has never been a risk-free, perfectly calm moment in history to invest. There never will be. The question has always been the same. Are you the investor who panics, or are you the investor who positions? Be the one who positions. Your future self will thank you for it. If this gave you real value today, drop a comment below. Tell me which sector you're most focused on right now and why. And if you want to go deeper on any of this. Defense stock analysis, energy positioning, how to build a recession, and conflict-proof portfolio from scratch. Subscribe because that's exactly what's coming next. See you in the next one.